Hello and welcome to Kitco Mining with me, Paul Harris, where today we're going to get an update on critical minerals with author and investor Gianni Kovacevic, who is the author of My Electrician Drives an Electric Porsche. Gianni, welcome back to Kitco.
Very nice to be with you, Paul. We've met all over the world. We've done many discussions, but it's been a while, I think, since I haven't really seen a good interview on touching all the data points around these themes. The gold and silver gets lots of coverage. So today is the day for these electric metals.
Exactly. It's been a while since we last spoke, and we're going to address that. But, as we get to start the conversation, what have you been up to? You've been sort of relatively quiet for a while.
Well, I still spend 2 or 3 or 4 hours a day staying current on these themes. I have investments within the sector, as most people will probably understand. I was a founder of Copper Bank, which now become Faraday. I was a founder of Lithium Bank, which is still running its business. And I'm with those companies usually about 5 years, and then I go and do something else. But I usually do one at a time. But the master theme of what is going on and why am I still so fixated on this trend of electrification? It's because it's happening in real time. And believe it or not, this is in a bull market. It's a nascent bull market. I'm talking 70–80% things have moved, right? So if you ever owned a lithium share, if you ever made money in a lithium share, I'm just going to deliver the facts like a report card. So we're going to go all the different data points.
Let me stop you there, Gianni. We're going to get into that. But I was looking at your book in preparation for this interview. I was going through it again. It's about 10 years since you wrote your book. What has changed in that time and what hasn't in terms of the overall sort of macro narrative that you're talking about here?
Well, we were talking about the electrification in the world, namely transportation. And China, I would say, has exceeded everyone's highest expectations. Everyone would know now that over 50% of the cars that are sold in China are electric. What they've done with their buses and mechanical delivery trucks and stuff like that is unbelievable. They exceeded everyone's expectations. Fortunately, they're the largest car market in the world. In the United States, however, they've disappointed. I don't think sales have been quite as good as everyone thought they should have been. And the main driver there is the experience that if you were, other than Tesla, but if you were trying to charge an electric car in America, epic fail. You had a very bad experience. It's clumsy. You have to sign up for all these different things. Sometimes they don't work. They're not well situated. So you still have that stigma, and that resulted in very poor sales for companies like GM and Ford. But that's changing. The consumer will see that these things are going to get addressed, irrespective of policy or who's president. For many people, not everyone, but for many people, it's an amazing customer experience. And as we get through these next 2, 3, 4 years, you're going to see it's just going to go. But basically what's happened in countries like Denmark and Netherlands and China and Japan and Singapore, you're going to have it's going to repeat itself, in my opinion, in America I'm talking about.
Now, we're going to talk more about lithium, but in terms of helping to set the context for our conversation, I think it'd be fair to say that the critical mineral space is nothing if not dynamic, with the US government in the process of updating its list of critical minerals to, I believe, 54 minerals, now including silver. And we're also seeing direct US government participation in mineral companies such as MP Materials, a rare earths company a couple of months ago. And now this week, Lithium Americas, the Department of Energy, said they're going to take a 5% stake in Lithium Americas and a 5% stake in its joint venture that's looking to develop the Thacker Pass lithium deposit in Nevada. Gianni, let's start here. What's going on here with the US government? Why is it looking to get direct participation in mineral companies and mineral company projects?
There's a great cartoon, and perhaps it's the most interesting political cartoon I've ever seen. And it's, imagine two hobos stumbling down the street, and they're both drunk and they're leaning on each other. On the back of one hobo is China, on the other is the United States. We all know they're very codependent. There's many things that America has and does that China cannot do, and many things that China has and does that America can't do. This is predominantly a military thing. To have this dependence on certain items and certain technologies, really the refining capability, which China has, as everyone is well aware of now, they want to, and they can't do it overnight, but this is going to take place over certain years. So when you're talking about critical minerals, you got two buckets. One bucket is the, let's say, defense and security and magnets and things like that. And the other one is simply driving forward modern energy technologies. And so the US government is there mostly for, I would say, from a military perspective. But we don't need, dozens and dozens of these rare earth mines or antimony or tungsten or scandium. A few of them will sedate what they need to do, but they also have to have the processing capacity. Whereas the bigger opportunity for the speculator and what's going to be multi-year are the energy metals, because that's growing in the case of these technologies, which shoes into something like lithium. We're talking 20% CAGR growth rate, which is just a tremendous opportunity.
Okay, now the lithium price has been oscillating wildly over the past few years, from extreme highs to extreme lows. It finally seems to have bottomed out. Where are we in the lithium cycle?
When we're talking about lithium, there's two parts there as well. There's the actual material mining, processing, but there's also all the technologies. So people that are not aware, with the biggest ETF, it's called the Lithium and Battery Tech ETF. The symbol is LIT on New York. And it bottomed. It's a ski slope, just like all the other sort of lithium or battery tech related things were, until about April of this year. LIT would bottom out at 3150. And then the trend changed. 5% up, 10%. You can definitely see a trend change. When you get to 20% move, that's the start of a bull market. It's went to 3150. It's now trading at 59. It's up 85% in 5 months. That is a bull market. And it's not happening because the lithium miners, even though they have moved, Albemarle's moved, and these technology companies have moved. So if you look at the composition of the LIT, it's about $1.2 billion, half and half materials, technology. The single biggest holding is Albemarle, 7.5%. And Albemarle's had a big move. They own about 120 million of, it's about 1.2 billion LIT total, but something like over $100 million is actual Albemarle. For context, Tesla's number 7, holding 4.5%. CATL, the big car and battery company out of China, also 4.5%. So by looking at these companies that they're investing in or waiting in, if you will, it's an ETF, that tells you that the sector, the investor interest is there. They're not so interested right now at the lithium price. Everyone understands that strange pricing environment is not sustainable. One example, in around 2017, 2018, Australia would then surpass Chile as the world's largest lithium producer, and by far, they never look back. There is only one profitable operation in Australia, Greenbushes. Now, you don't have to get a pencil and paper to calculate too hard. That's not sustainable. So that's not a question of if, but when the price of lithium is going to take care of itself, because it's not sustainable. And even though we understood what was going on in China and sort of this strange pricing environment, even CATL shut down their large operation. It just wasn't sustainable. You cannot lose money every single day. I think what the Chinese were doing at the time was like, imagine an example. If you're exporting raw logs out of British Columbia for a loss, but you're able to make high value products out of those logs and sell it to the world. That's kind of what they were doing with that, and holding back, frankly, the West's ability to put some of these projects into production. That's all changed. And a lot of these deals that we're seeing are not, they don't care about the lithium price or the price of these things or the rare earth prices. It's really about how can we have access, guaranteed access for the next 10, 20, 30 years, and most importantly, the know-how, the knowledge. They have a step on the West, but that is something I think there's a siren on top of that. So in the next 3, 5, 8 years, there's going to be a bit of catch up, and that's, I think, good for the industry, good for the companies that are going to be producing lithium, and more importantly for security for governments, namely United States, Europe, and Canada.
Let me push back on that, Gianni. How is the lithium sector going to escape this extreme price volatility? In volume terms, lithium is still a relatively small market, 800, 900,000 tons per year. As soon as the price moves higher, there's a lot of marginal production that can come on stream. And when that marginal production comes on stream, it knocks the supply and demand balance out, and you get the prices plummeting again. What's going to prevent that from happening again in the future?
That's a very good question. And that's maybe the most important question you could ask for what we're talking about today. The CAGR growth rate for lithium is around 20% demand growth, which means the entire lithium market is going to double again, rule of 72, in about 3.5 years. Now, 3.5, 4 years doesn't matter. It's becoming increasingly a more important commodity. Now, here is the pecking order in the metals. Why I'm going to answer this in a very sort of specific way. The world's most traded commodity value-wise is oil, over $2 trillion. Always has been, always will be. Typically, it's more than the entire metals complex altogether. But let's talk about the metals now. You have, in size, total value, iron ore, gold, copper, aluminum, nickel, zinc, silver. Okay, so we see that. The other ones, things like molybdenum and palladium and stuff like that, they're way off the chart there. When the lithium market doubles in the next 3 years, which it will, not a question of if, but when, and the pricing cannot stay at all-time lows forever, as I already told you, you cannot have one single operation in Australia that's profitable, not sustainable. So let's say the price of lithium goes to 20,000 from 10, 11. All of a sudden, lithium becomes one of the 6th or 7th most important metals. Okay, with that importance, it becomes a more mature market. You're going to have more mature pricing discovery. You're going to have a futures market. So I don't believe it's going to be the same as some of these niche metals, which it always has been. It's now, right now, becoming something more important. But in the next 3-4 years, and the CAGR growth is not going to change. I do not see any scenario where you see nothing but something like 15 to 25% demand growth for lithium. And I believe there's an incentive, not that people are nice, there's business to be made there, and price discovery will not be the same as it was for the past 6-7 years. So for that reason, I think it won't be like it was before. It may rhyme, but you're going to see a more mature market, you're going to see a futures market, and far better price discovery, specifically as a lot of that comes to the West, and people are going to want to have their production and all the offtake that's happening with a lot of these operations as well. Right, so it's part of their economics is the fact that someone's actually taking the back end at a certain bare price. And if you look at the economics on, 20 or 30 lithium development projects, no one can use 10,000. Of course, it's not economic. This is just like nothing is really profitable in a lot of parts of the world. But the average is around 20,000. We need to see a stabilized price around 20,000, and then when you add that up, lithium becomes on that chain. Remember, iron ore, gold, copper, aluminum, nickel, and then lithium will be somewhere there. As important as you have something, maybe not quite as nickel, but somewhere there. And that's coming. I think it's unstoppable.
Now, lithium, as well as the broader basket of critical minerals, the pricing is typically established in China because it's the leading producer and processor of many of these minerals. But a lot of Western industry participants say that pricing is unrealistic, and that the Western world needs to get its head around having to pay higher prices to ensure secure supply lines, which in some ways is reminiscent of the 1970s oil crisis, when Western consumers had to get their head around higher oil prices being a thing going forward. Does this mean that Western governments need to support pricing with perhaps floor pricing, or perhaps help lower the cost of capital that developers face, shortening permitting times and costs, things of that nature, so they can be more competitive?
Yes, it's certainly going to help, and I think we've seen some of that. There's been really almost an unprecedented amount of government support for really a lot of the projects here in North America, also in Canada. But I still believe that if you look at what the overhang could have been in lithium, was it 100,000 tons or so? I mean, we need to build, and just put this in perspective. So we don't need to build dozens and dozens of graphite mines or antimony mines or tungsten mines. But if you look at the lithium market growing by 1.5 million tons, if the average feasibility or economic model is for between 10 and 20,000, that's your typical proposed operation in lithium. The biggest ones were about 50,000. So the contested project in Serbia, Jadar, that was about 50,000. That's would be a huge operation. But the average is 10 to 20,000. So let's say 15,000. If we need in the next 4 or 5 years 1.5 million tons of lithium, Paul, and I'm not trying to be funny or cute, but that's 15,000 tons That's 100 mines. Now, maybe some of them are going to be a bit bigger, but we need to build 70 or 80, lithium operations. So this overhang, if we're talking an overhang of 100,000 tons and the market's growing by 20%, this overhang will be gone. I mean, certainly through the year 2026 into 2027, that's already scarcity. So if some of these other operations can come online, perhaps, but you're going to have to, being the lowest quartile of production is going to matter. And for now, at least for now, if you can have some level of base floor protection, maybe it doesn't have to be 20,000, but 18,000 or something, just like the Chinese have been losing on certain operations, but taking the material. And let's see, I mean, we're not talking about a lot of jurisdictions here. We're talking about, typically, I follow DLE, so we're talking about Arkansas, we're talking about perhaps Texas, we're talking about Alberta, and then with the hard rock mining, this does not happen in too many jurisdictions around the world. With us, we got Quebec, Ontario, hard rock, Alberta, Saskatchewan for these brine projects, and it makes sense. I think there's a lot of employment, and it really is a future pillar of the global economy. This is something for 50 years that's going to be important, and there is at least a glimmer of the government understanding that, particularly in a province like Alberta, where they already supported oil sands development through the late 70s and into the 80s, and now look at that industry. It's commonplace. They produce millions of barrels of oil every single day, and tens of thousands of people are employed in Alberta in doing that type of industry, and they do truly see it that way. They look at lithium and DLE as a future cornerstone of the Alberta economy.
Okay, I'm glad you've mentioned DLE, which is direct lithium extraction. That's seen as the magic lamp that many companies, particularly big oil in the Smackover Formation, Alberta, as you mentioned, in Texas and Arkansas, a lot of companies are rubbing this particular magic lamp in the hope that it will solve and revolutionize processing. How is DLE evolving? There's not really commercial application of it yet. Will it be the solution that many will hope for? And of course, at what cost?
DLE is direct lithium extraction. And this is something that's been embraced by Rio Tinto, Exxon, Chevron, Occidental, Koch Industries. And this is the future of lithium mining. And I'll tell you why. The constraints in South America, particularly Chile, with the water consumption, makes it very difficult to really expand that type of production. Hard rock mining, you go through basically the same type of permitting regime as you would a copper or gold mine. Why do they like DLE? It minimizes environmental impact and improves efficiencies. If you were to scrub away the rationale from the companies I just talked about, Rio Tinto, Exxon, Chevron, Koch Industries, Occidental, and Schlumberger, which is Lithium Bank's partner in Alberta, this is something, it just makes good business sense. It requires 8 to 10 times less water. You get your lithium almost instantly. The footprint is a postage stamp. Imagine you're pumping up brine water, taking it through a process and re-injecting the same briny water with a little bit less lithium involved. They look at this. Exxon has said that they're going to be producing commercially in 2027. Pretty serious company. I'm not going to, go against them. Rio Tinto in August, they merged their fabled aluminum division with lithium. So they now have iron ore, copper, and what they're calling aluminum and lithium under one umbrella. And Rio Tinto says lithium is going to be 15% of their global business in the future as they move forward. And they're also proponents of DLE. I think it's like millimetrical progress, but in the end, they keep moving the chains forward. And it reminds me of the when they were developing horizontal fracking, Paul. And I've used this before in my presentations, but just very quickly, nobody believed this would work. And this is something that George Mitchell, which he owns 60% of Mitchell Energy, and he kept pushing it forward, and people thought he was crazy. They were drilling north of Dallas, Texas for gas, and they were fracking. And finally, they cracked the fracking code, and gas production rates skyrocketed north of Dallas, Texas in the early 2000s. And then with Devon Energy, with Larry Nichols, they merged the two companies, and Devon Energy was doing the horizontal bit. And they merged Devon Energy with Mitchell Energy. They drilled in 2002, it was like 7 wells, horizontal frac wells, nothing for gas. 2003, 55. And then they switched to oil around 208, 209, 2010. And of course, the production rates just skyrocketed. The Saudis collapsed the oil price. Did you know that they drilled, the North American industry, 150,000 horizontal frac wells by the late 2010 teens? They had done at that time, when the oil price collapsed, about 200 outside of North America. So never doubt the oil and gas industry, because I know people might not have so much confidence in junior miners or developers, but you're talking big oil and gas, and they really believe in this. So if I'm a speculator, I'm speculating with them. The juniors and these DLE juniors are anyways, they're practically worthless, and that is, if the industry's already in a bull cycle, a lot of that's driven by the technology, but also the lithium companies, just like oil, just like silver and gold, when the developers take off, it will trickle down to the highest quality developers, in my opinion. And that's something people have to be looking at. It should be written down on their desks.
So if DLE does work and big oil can become big players in the lithium space, what does that mean for all the smaller companies? Does it mean the end of those, or all of these explorers looking at, in the sort of James Bay region of Quebec, for example, looking for spodumene projects into that? Are they just out of the game completely?
No, that's not true. It's going to be from all sources. You're going to have location matters. Just like in oil and gas, there is such a thing as the best situated barrel of oil. There is such a thing as the worst situated barrel of oil. Hard to extract in a bad location, what have you. I already alluded to the fact that we need about 1.5 million tons of lithium in the next 4 or 5 years. And if it's an average of 15,000 tons going to come from a project, that's 100 operations, maybe a little bit less if some of them are a bit bigger. So it's not going to be any 10 projects or any 15 projects. It's going to be, let's call it, we're not going to build 100 lithium mines, obviously, in the next 5 years. We all know that. But we need like 30 to 50. So it's not just going to be hard rock. It's going to be more difficult for salars. We've been to Chile. I've been there many times. I've spoken with the government. I did the keynote at the CESCO Copper Dinner in 2017. I know it very well. Water is an issue. It is incredibly water intensive. There's no propensity they're not going to be able to double lithium production in Chile. They're just not. And with hard rock mining, it's going to compete with DLE. So if you, scrubbing from their verbiage, DLE, they like it. Why does big oil like it? Why does government like it? Because it minimizes environmental impact and increases efficiency. People have to write that down. Do not, this is just how they see it. And if the footprint is a postage stamp compared to a hard rock mine, and if the technology is there, it becomes increasingly difficult to go against that kind of extraction, because it's going to be the go-to play. And I don't see big oil and gas, which specializes in this type of extractive industry, they're not going to get into the hard rock mining of lithium, but they are going to get into the moving of water, processing it, and re-injecting it. That is their core industry. That's their bread and butter. And they've already made the decision. This is already occurring. So they've made their bets. So to me, if that's where the data is lining up, I'm following very carefully DLE, but it's going to come from more than one source. Remember, we need 1.5 million tons, which is going to be dozens and dozens of lithium operations when the price is more normalized. There's going to be a lot of aptitude, a lot of investment there to support that, and it's going to be less and less so. I think for the hard rock, but not tomorrow. This is more 2027, 2028, 29. And every single time you see a positive press release for DLE, those companies that are in the DLE business are going to benefit. I think we have to do a case study on the strangeness of valuation. If you want later, I can do that.
Okay, well, let's bring graphite into our conversation. Graphite is the other major mineral component of lithium-ion batteries. Talking to you before we recorded, it seems graphite is another mineral that big oil is waiting in the wings to potentially dominate. A lot of the juniors out there, graphite companies, they're looking at producing natural graphite, a market that China dominates, but it's perhaps its major competitor, and the key competitor going forward will be synthetic graphite, which is another sort of product that big oil is very well equipped to develop and bring to market. What's going on in the graphite space, Gianni?
Well, China absolutely dominates graphite. I mean, almost exclusively. We all know that. And so I'm gonna use my friend Chris Berry. He always talks about it. If you want to get a better understanding what the customer wants in graphite, he calls it the Holy Trinity: sizing, shaping, purification. Okay, and the ability to provide those people that require the very types of qualities of graphite. And can oil and gas deliver that to the market? I, once again, am not going to go against that. I think that certainly the science and technology is there, the will is there, but it comes down to how many graphite mines, natural, are we going to require? It's not like lithium. And as I said before, all these other niche metals, they do not have the same already established dramatic growth, but more importantly, this parabolic growth we're going to see in the next 4 or 5 years. So it's something that I think the biggest project in the United States is, if you're probably well aware of, Graphite Creek, lots of support there. That project has gotten a significant support. Probably it ends up becoming some kind into production. And so how many, once that's in production or once that's moving towards production, and as you get this, once again, just like DLE, millimetrical progress towards synthetic graphite, how many operations do we need? What is the growth potential? As far as I understand, the CAGR growth rate for graphite somewhere around 7-8%, going forward. So can this be sedated? Will it be sedated? And is China going to loosen its reliance? That, I believe, is going to happen. But it's going to happen. We don't need to have dozens and dozens of graphite operations. You need some. And we have it in Quebec. We have it in Alaska. And in Sri Lanka and some other places. But it's not going to be the same level, the same amplitude. It's not going to become on that pearl of metals that I was talking about, where lithium becomes the 7th or 8th most important. That's not going to be graphite.
Okay, well, let's round out the quadfecta of energy minerals and bring in uranium and copper. The uranium price seems to have been range-bound in recent times, while copper is starting to pop on news of supply disruptions at various large copper mines around the world. President Trump imposed tariffs on copper semis earlier this year, not copper raw materials. What do you think, or what's your view of how the Trump administration is advancing the cause of energy independence in the United States?
Well, it's been a bit clumsy, hasn't it? There was a bit of an own goal. We saw when the tariff was first introduced, it was, the price of copper went up $1 a pound. And most of the operations in the United States, first we'll talk about copper. It is going to be concentrate. And they don't have the propensity to want to build smelters in the United States. So once again, that concentrate is going to have to leave the shores of the United States, go somewhere, be smelted, and then sent back at a premium or fabricated already somewhere else into something that, 75% of the world's copper is fabricated into something to generate, transmit, and utilize electrical energy. So we're not going to see that in one presidential cycle, that they're going to be, doing more refinement and of copper in the United States. This is not going to happen. So how much copper oxide is there? How much copper cathode can be produced? A little bit. America does have the ability to do that. And I think that's anyone that can produce that kind of a project in the future is going to have a premium. So the second part of it is your question is the uranium, which is also ties in these energy metals. And I wonder what would happen if this Kazakh Russian sort of their ability to actually refine uranium, America does not refine its own uranium. It can produce it, but it's importing all that fuel. And as we go down the path, 2, 3, 5 years, 10 years down the road, that could put a serious kink in the armor there. And I also don't believe I've been someone that's understanding that the will is there, but where are these reactors going to get built, Paul? I don't. When it comes really push comes to shove, it's going to be hard to find a county that's going to want to say, hey, build it in my backyard, or a governor that's going to champion it. And who wants to die on that political hill? It's going to be very difficult. I think you can talk a lot, but are we actually going to see this huge influx of nuclear reactors? And by the way, even if they do get to that and they start building them, the first pound of uranium won't be procured for these new operations for 8-10 years down the road, which leads you to the SMR, the small modular reactor. And that is where the huge push is in these sort of, I guess you could call them startups. They've had a tremendous amount of increase. This Oklo, I don't know if you followed that one, but it's went from $6 to $140 a share, which is that Sam Altman startup focusing on SMRs. And once again, I'm not sure that that's going to be consuming uranium, not right now. So I'm very neutral on that. And I think that the clumsy policies, people don't have any sort of faith in them. We've seen the backtrack with tariffs and these policies. No one's making these multi-billion-dollar decisions because of, sort of the wish or the will of the U.S. government, either federal or state-wise. And it's going to be no investments going to be made because of those policies. I don't believe day by day.
Okay, well, Gianni, maybe we've stumbled upon the subject of your next book. Maybe call it My Electrician Has a Modular Nuclear Reactor and a Data Center.
That could be funny. I think I have a different book in mind, but it really lends to being a speculator and looking at inefficiencies in the market. And I think that right now, if we're looking at one thing, is that just to highlight for people that this lithium trend, or the things that feed into it, that part, the modern energy, the stuff that has not been embraced by the Trump presidency, it's moving forward. And even the U.S. car manufacturers, they are going to continue to move that forward because it's the future. We all remember what happened in the early 1980s, where they were making, in the 70s, Americans made those big, very fuel-efficient cars, and then the Japanese came in, and everyone was buying the Japanese cars, and what happened? All of the entire retooling of the U.S. automotive industry went towards lighter, more fuel-efficient cars. And that same thing is going to happen, and it's the only market, really, where you haven't had explosive takeoff. But to remind people, in a car market that's 90 million units, the U.S. market is 16, 17 million units. So it's less than 20% or around 20%. You have to go with the leaders. The leaders are rest of world, namely, of course, China, which is almost a third of every car that's made and sold every year is coming from China. And we're not going to be able to suppress the sales of those cars. You see now the Europeans, they're embracing it. They cannot retool their factories in Europe without Chinese assistance and technology. And it was always backwards. They were always worried about the IP, the German car manufacturers going to China and having them, steal their IP. Now it's the other way around. And it's, you can't stop it. I think the genie's out of the bottle. And for that reason, we're going to see this trend is going to continue. It's inevitable that we're going to see a lithium 3.0 boom market. I think the setup is already there. And now looking down the food chain, it's, I think people have to look at these juniors as well.
Well, this has been a fascinating conversation. Gianni Kovacevic, thank you very much for joining me today.
Thanks, Paul.
And of course, to our viewers, if you like what you see, don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.